once again extend my greetings to all of you, and hopefully we will have a couple more of weeks to finalize Learning Unit 5 very well, because as per the advice I gave you earlier, is that you need to be able to finalize properly Learning Unit 5 so that you can understand Learning Unit 6 and Learning Unit 7. Obviously, these learning units will be of paramount importance for your exam. So I ask again the class to ensure that you do your best to study and to read, to complete, and not really necessarily much reading. I think it's more of much practice, and I would like you to be in that rhythm of more practicing, and there's certain notions that you would only master after much practice. All right, so valuing the inventory. So we did touch in our introduction to Learning Unit 5 on these two methods of valuing or inventory valuation, right? We did touch on the first in and first out, as well as the weighted average method. Okay, so these are very important. Remember that these are only methods, right? First in, there's nothing to it than what it says, right? So first in, first out. So whatever inventory is bought first will be also the first to be sold, or within the manufacturing, will be the first to be used, Although there is some level of intricacies when it comes to tracing, really, especially within manufacturing, tracing the inventory that was used. And it can be quite a difficult exercise. And you will understand more why we are doing this and why we would like you to have your clear mind on these notions, right? So I remember during worrying about the first in and the first out, as well as the weighted average methods. Again, just a reminder that these are methods, right? These are not systems. These are not inventory systems. And we shall actually touch on the inventory systems in just about now, right? So you do have two inventory systems that you need to keep in mind, right? There is the perpetual inventory system. And again, no mystery to it than the fact that it is perpetual, meaning at all time. If you remember very well your introductory learning unit 1, we did touch on these inventory systems. But like I said, each chapter delves deeper into some of these notions. So the perpetual and periodical inventory system. It is how you record the inventory. When we talk about an inventory system, it's more about how you record. And that's where the notes that I've provided you can be quite easy for you to just quickly break down and waste not much time on the reading part of it, right? So you have the inventory valuation methods, and you have the inventory system. So an inventory valuation method is different from an inventory system, right? So you are valuing inventory, the inventory with the inventory valuation method, right? And that's why you have your first in and first out, as well as the weighted average cost method, right? And we're going to dive it up very soon, right? But when you're looking at the inventory system, you are talking about the perpetual and the periodic. The perpetual, obviously, the value of the inventory is calculated after each transaction, after each purchase, after each sale, right? the value of the inventory is calculated. And on the accounting part of it, the inventory costs are charged to production or cost of sales or cost of goods sold when the inventory is sold, right? So as soon as an item that was produced is sold, then at that very exact time, then we charge the production or the cost of sales or the cost of goods sold. If you remember again, your income statement, you will have your sales, you will have your cost of sales, you will have your gross profit. You remember that perfectly, right? So something will be happening there, but before something happens there, when a sale has gone through, right? Before something happens there, all transactions for the perpetual will be recorded in an inventory account. And you know where your inventory accounts sit. Your inventory account sits on your balance sheet, right? Under your current assets, right? So two different things. So you have the first, once an item is purchased, inventory is purchased or acquired, whatever verb you want to use there. As soon as it comes in, we have to record that inventory under an inventory account, and that inventory account is on your balance sheet under your current asset. If you remember very well, that's where it's going to sit. So picture that in your mind. This should be the stage that after you've crossed the foundational stage, you can now be able to picture certain things in your mind, right? And as soon as that item is sold, so automatically we're going to charge now that cost that was in the inventory account, right? We're going to charge it to the production or the cost of sales or the cost of goods, right? On the income statement. So I trust that that is super clear, right? The periodic inventory system is different, and it says it's periodical, or it's periodically that we take stock to account of the inventory, right? So the acquisitions and reductions, which are your plus and minus, right, are not recorded in the inventory account as it is the case of the perpetual, you see. So in a perpetual inventory system, we record the inventory or the transactions for the inventory, we record it on the inventory account. That's not the case for the periodic. Because why? Because the periodic, we do it at the end of a period. We do the stock take at the end of the period. So the accounts, so whether it's acquisitions or reductions, those are going to take place in a special account that we call the purchases account. And so those are for the periodic. So the costs are unknown, contrary to the perpetual inventory system, where we know the cost of the inventory at all time. And the reason why I'm spending a bit of time would have to do with the example that we are going to tackle just now. So, but it's important that you understand this very well, right? So obviously we can't know the cost of inventory at all time, because that will only be calculated at the end of the trading period when a physical count is made. So the cost of inventory is unknown at the end of a transaction. That's not the case for the perpetual. At the end of each transaction, we know the cost of the inventory, because those are tracked closely. And we did actually even give examples of a perpetual inventory system would be like your, your shops today, all sort of shops, whether it be where you do your groceries and your retail shops, they have this inventory, this perpetual inventory system because they're able to track. Obviously, today with the we are the age of computers and all that, they're able to scan the barcodes and automatically it updates in the system. But we did say, for example, your small businesses like your spaza shop, those could be doing things still manually, and they don't have a system that an inventory system that is tracking every transactions as it happens, right? So that's a good example. So now I hope now you are clear. You understand what an inventory system is. It's just about how we record inventory, and that can be perpetual or periodic. But as to valuing, inventory to give actually a true value to the inventory, we need to use either the first in or first out method or the weighted average cost. Okay. So now that we have done with that, we can now go quickly to example 5.1. Obviously, you will have some chance to go yourself through example 5.1, but just for the purpose of the class tonight, we are going to touch on this example, right? So I think it's Kendrakis Enterprises. Like I said, we don't worry too much about the name of the company, right? But what we understand from this company is that they, from the very beginning of the month, right? So we are given already a particular period. So it could be April 2023 or 2 or 3, whatever it is, but we know that for that year, in April, at the beginning of April, they had already acquired 5,200 units. And they do actually tell us the selling price, which is 3 rand. What is provided again to us is that there is a markup. You know the markup, you know what it means. It's what we add, what we add to the cost to get to the selling price, right? So they gave us the selling price, meaning that we don't have actually the purchase cost. We don't know how much they've how much or what is the price per unit, or the cost, sorry. What is the cost per unit? We are provided the selling price, but we don't know what is the cost per unit. But we are given a clue. We are provided with the selling price, and they say that there was a markup of 20%, meaning that we can work backwards. So from the 3 rand, 20% was added onto something to get to 3 rand, right? So obviously, this is the 3 simple rule. It's very easy. So if it's 20% over and above the cost, for us to find the cost will be the 100%. But if they added 20% to the cost, which is 100%, which is a unit, right? A unit cost. If they added to that cost 20%, so we start with 120%. So 120% represents that 3 rand. Okay? And it's a very simple rule. So if 120% represents 3 rand, what would 100 represent? What would 100 represent? It's simple. You just take 100 times 3 divided by 120. It's a very simple rule. It's a quick one, but in any case, I've put it in your notes, and you can see it as we go through it in class, so you know how actually to deal with this. Pretty simple, right? So actually think if the correct term to it should be the 3 simple rule, right? So 120% represent 3 rands. Okay. 100% will represent what? So you take 100 times, you can forget the percentage at this point. You can just say 100 times 3 divided by 120. All right. And so that will give you 2.5. And that makes sense. And you can check this. You can check this because you could multiply this by 1.3. You should be able to get 3 rands. 1.3? Oh, no, 1.2 because it's 120, right? You add a markup of 20%. So if you multiply 2.5 times 1.2 in your calculator, you should be able to get 3, right? But that's basically to say that's how you work backwards to say, oh, all right. So the first batch of units that they have, 5,200 units, right? That batch was purchased at a cost of 2.5. That's how you start from the get-go, from the beginning of your example or your question in your exam. You figure out, first of all, what's going on with the few first line, right? So after you've worked this out, then you say, okay, I know this 2.5, yeah, it means something now, right? But then they give you also now transactions for the month. All right, there's more than one, right? So at the beginning, so you can call that the opening balance. That's what you call it, the opening balance. There will always be an opening and a closing balance when it comes to accounting, right? Because you are accounting, right? So you look at now the transactions. They tell you on the 2nd, on the 8th, on the 13th, on the 18th, on the 24th, and the 30th of the month, they have done transactions. On the 2nd, it was purchasing an additional 2,000 units. Makes sense, right? So there is now more units, right? So they're purchasing units, and at the same time, on the 8th, they're selling. So there is ins and outs. So now when we are buying, when we are selling, we are provided actually with a selling price. So no, actually, yeah. So look at the 8th. So the purchase that was done on the 2nd, it's at 2.75, slightly higher than at the beginning, right? The previous day on the 1st, the 5,200 units were purchased at 2.5, and we worked that out. On the 2nd, we're purchasing additional units at 2.75, slightly higher. We are selling those same units at 5.41 each. And it doesn't change. It seems like all sales, are sold at this agreed upon cost. Price at 5.41. All right. So there is this 5.41 here. As you can see it here, there is this 5.41. Right. But we had other purchases. So on the 13th, we had a purchase of 1,000 units. On the 18th, we had another purchase of 4,000 units. And you can see that these are coming at different costs. And that's where first in and first out will start to make sense now. Okay, let me just finish the question in itself. So what are we asked to do? So for each of the FIFO and weighted average cost inventory control methods, the following will be determined. So what they want you to return to provide is what is the value of the closing inventory on the 30th of April, right? Makes sense. So the 30th April, what will be the closing inventory if you have to take into account all the valuing, the inventory valuing method, FIFO and weighted average. Actually, let's not waste time with inventory valuing method. Let's just say with FIFO and weighted average, right? With these two methods, what will be the closing inventory? Also taking into account, we might even go further and say Let's also look actually at the perpetual inventory system and the periodic inventory system. So we're going to have for the perpetual inventory system, we're going to look at the FIFO and the weighted average. And for the periodic inventory system, we're going to look also at the FIFO and the weighted average. So this is going to be very exciting, right? So we're going to have actually four closing inventory values that we're going to provide. We're going to also look at the sales revenues. The sales revenue are not going to change really, because remember, this is more about the inventory. All right. This is more about the inventory. Inventory, your inventory is also somehow related because it's purchased, right? It's also somehow related to your cost of sales. So I can anticipate that the cost of sales was going to change, but the sales revenue is not going to change, but the cost of sales is going to change. Therefore, the gross profit that we're going to find will also be different on these different methods, right? Remember, we're going to look at four things. And that's why I've provided you this. This is really something wonderful for you to see also comparison. So we will have the perpetual, and we will look at the FIFO in the perpetual, and we will look at the weighted average in the perpetual inventory system. And then I've provided you also with the periodic next to it so that you can see the difference between these. And I'm sure that by the end of this class today, this will be already like a big chunk of close to half of your learning unit 5, right? So let's go deeper. I think Cody is here, and I hope Cody you enjoy, right? So let me this is again, like I said, the fact that I have juxtaposed them, I've put them next to each other, it's for making it easy for you to see what is happening and to compare. So that, for example, let's say you are in the exam, they say, could you provide us with, use the weighted average, so the weighted average cost method within the periodic inventory system. You might easily be confused. You are wondering what is happening? How am I going to remember this? And that's the reason why I've put them this way. They're very easy, and you will understand that it's just a game, and will require the next thing that will just be required from you is to practice so that you know exactly what you are doing, right? But the theory, we've covered the theory. Remember, we took a bit of time to just look at the perpetual, with the difference between perpetual and periodic. Perpetual at all time, perpetual, it says it at all time. So we would know the cost of the inventory at all time. That will not be the case in the periodic, because we need to do a stock take at the end of a periodic, right? So that will not, so we wouldn't know every time a transactions happen, we wouldn't know exactly what is right now the cost of the inventory, right? Okay, so let's start with the FIFO year, right? Remember, we said it's perpetual. We know at all time. Whenever a transaction is made, we know. But within the FIFO, within the first in and first out method, so what is first in and what is first out? That's the good thing. That's why you divide. You can put your date in a table so that you are tracking each transaction. So this is for ease, right? You can track each transactions with the date. Remember that we had an opening balance of 5,200, right? That's the opening balance there. And you know that that was at the beginning of the month, right? And we have put purchases. Purchases is what we are buying, what is coming in, the inventory that is coming in. And the issues is when we are selling it out. Very easy. That's the only three things you need to be able to track your inventory. All right. So we know at all time 5,200 units were bought at this. Remember, we worked out this cost 2.5. We worked it out, right? But then on the second, we had another purchase of 2,000 units at 2.75. What is now the total? The total is now 5,200 units at 2.5. You don't do an average year. There's no need to do an average year, because what comes first? needs to go first, and what comes after needs to go after. That's basically the FIFO. But now, on the 8th, we sold 6,000 units. So what we're going to do is 5,200 units that came first, those are the one we're going to sell first. And remember, at what cost are we selling them? We are selling them at the exact cost that we had agreed on, right? 2.5. So 6,000 units, we deal first with the 5,200 unit that came, but we still are left with 800 units to get to 6,000 units. Because remember, our customer wants 6,000 units, right? We need to give them 6,000 units. So there is 800 units that is going to remain, and that 800 units, we're going to take it from what came on the second. So the second purchase was of 2,000 units, right? So we would take the 800 there from those 2,000 units. At what cost? At 2.75, right? Not at 2.5, right? But at 2.75, because that was the cost when we purchased, right? And I can now now you understand what is happening. What will be the balance? The balance will be 1,200 units, because if we take 800 units from the 2,000, what is remaining is 2,000 minus 800, 1,200 units at 2.75. Now it becomes a game. We purchase more, 1,000 units more. We include them in our balance. Now we have 1,200 units that was remaining from the sale, right? And now we have an additional 1,000 unit that came in at a different cost, at 2.85, right? We're not doing any average. We're keeping it like that. And we will have another purchase that was done on the 18th of 4,000 units. That's a big one, right? So how are we going to do? We're going to start with what we had first. What we had first was the 1,200 units. We're going to then add the 1,000 units. But that only accounts for what? For 2,200 units. All right? That's only account for 2,200 units. And so, oh, sorry, Baba, what am I saying? So there was a purchase of 4,000 units. The sale happened on the 24th. And that's why you see why you need to use these tables. These tables will keep your structure so that you don't make a mistake, right? So the sale actually, it was not these 4,000. This 4,000 was a purchase, right? Okay. And that purchase is added, right? On top of, so it's part of so in our inventory account, we have these three now inventories that are sitting there. We have a batch that came in at 2.75, a second batch of 1,000 unit that came at 2.85, and the last batch of 4,000 unit that came in at 2.63, right? And now they tell us now that we need now to sell 5,100 units. Aha, that makes more sense. So what is going to happen here for the 5,100 units? We're going to start with first the 1,200 units. That is going to be gone. 1,000 units that came in on the 13th, as you can see, this one, and that will be gone. But that will only account for what? For 2,200 units. We're still left with 2,900 units. And that 2,900 units will come from what came last. The 4,000 that came last, we will take 2,900 units from it. And as you can see, remaining will only be 1,100 units at 2.63, right? Because remember the last batch that we are taking to get to the total. And you can do this total, right? This total is exactly 5,100 units. Okay? Makes more sense. All right. And we also purchase also on the last day. Surprisingly, we purchased 1,500 units. We purchased it at 2.75. And so this actually, the time that I've taken here, it's also to show you transaction by transaction what was happening. It will go quicker now in the other method, but transaction by transaction, you can see what was happening. And you can see that we would have in our balance on the 30th, we would have 1,100 units at 2.65 and 1,500 units at 2.87. It's actually easy for us to find the closing value. Do you see? The closing value, it will basically, for the FIFO, it's very easy. It's just going to be, you're going to take the 1,100 units, multiply by the 2.63, plus you will multiply the 1,500 unit that came on the last day. It came in at 2.87, and that's the multiplication, and you will get a total. So this is actually your closing balance. If you are using the FIFO method within the perpetual inventory system, you are tracking every transaction. You knew at all time the value of your inventory. Why? Because that is the perpetual system. Perpetual system, you remember, you know at all time a transaction happened, you know the value of the inventory. For the weighted average, it's just slightly different because the same thing, the dates don't change. Nothing will change with the date. Your table should always be there, purchase issue, right? But the difference here is that we are going to do an average, and that's the only difference. So these two that you see here, we will average them. We will average them. So we will take actually the 5,200 units that came in at 2.5 plus the 2,000 units that came in at 2.75 divided by the total. The total, what is the total? The total of first day and second day. First day, it was 5,200 units plus 2,000 units. What is the total? 7,200 units. You are doing this to get an average. That's the reason why you are doing this. You are doing this to get an average. And this is actually, when you look at the average on the second, this is your average. So you would have a total of 7,200 units at an average at 2.57, right? Easy. So when you issue the 6,000 units, you remember you issue a 6,000 units. When you issue those 6,000 units, you will issue them at this average cost of 2.57 that we worked out. Point A. You worked it out. You will issue at this average, right? And when you issue at this average, the remain will be 7,200. You issue 6,000 units. You will remain with 1,200 units at the average we had worked out. So every time there is a new purchase, you need to calculate a new average. Let me be clear again. Every time there is a new purchase, you need to work a new average. You see, there is a purchase of 1,000 units. So you will add to the 1,200 units for a total of 2,200 units. Point B here. But you need to calculate what then would be the average. The average, you can work it out as you can see. You work out the average. The point would be every time there is a new purchase, you need how many, look at the days, how many purchases were made? There are purchases that were made on the 2nd, on the 30th, and the 18th, and on the 30th. These were purchases. And you will see that you have exactly 4 averages. What does that mean? Every time there's a purchase, you work out a new average. That's basically for you the average the weighted average cost method. That's all it's about, right? Okay, there's an alternative format. You can try it out, see what works for you best. But we have our purchase, we have our issue, and it's easy for us, therefore, on the last day, on the 30th, to also be able to calculate the closing value, because we will take the 2,600 units at the last average that we worked out, it's 2.778, then we will get the closing value. I trust that that's super clear for you guys, all right? But however, I would like to touch quickly on this. And as you can see, to explain this and to practice, it takes a bit of time, but once you understand clearly what is happening. But on the periodics, it's slightly different, right? Do we agree? On the periodic side, because we cannot know the value, we only do the stock take or the calculation at the end of the period. Therefore, we cannot be tracking the value of the inventory at each transaction, right? Remember what was the rationale? The rationale is that we can't be tracking. We do it at the end of the period. And that's the reason why we need to separate our purchases from our sales, okay? Because we will look at the difference between the two, at the profit. We will calculate it at the end. So for now, we will just look at the purchases. So when you look, for example, at FIFO, and we will do again a table with three most important things. There is no balance. We're not calculating any balance at the end of the day. Why? Because we only do it at the end of a period, right? So not at each transaction. So if that's the case for FIFO method, for example, yes, on the first day, you remember we had 5,200 units. On the second day, we had 2,000 units. On the third day, we have 1,000 units that we were purchased. Another purchase came in at 4,000 units, right? And we issued, the last purchase on the 30th was 1,500 units. We had two issues. We had two sales. One of 6,000, remember? On the 8th, here on the 8th, you can see on the 8th here, on the 8th, do you see it there? I've made it easy for you so that you can see what is happening. So sold 6,000 and sold 5,100 units. You see, we had two sales. Those will be part of the sales. We'll put in the sales. So we will have a column for the numbers, the unit price, and the total value. That's all you need, right? That's all you need. So very easy now, right? So we know what was for FIFO. We know what was the cost, right? We know what was the cost of the 5,200 unit. We know what was the cost for the 2,000 unit additional. We know what was the cost for the 1,000 unit. We know all this. So we can calculate the total. Then we can calculate the total of units that we have. So the total unit that was purchased, total, was 13,700. That was the total. So you add them up together. You add up the total together. So we know also what is the total. We know what is the total for what? We know the total of all the purchases. So remember again, one of the questions they ask us is, what will be the closing inventory? Remember that. They ask us that question. What will be the closing inventory? All right? So what we need to see for the closing inventory, all right? Obviously, we need to see, for example, the sales. Here is the sales that we had. We had 6,000 units that we sold and 5,100 units that we sold. The total that we sold is how much? How many units? Sorry. It's 11,100. So we can see that what we acquired is slightly higher, 13,700, and we sold 11,100. So 13,700 minus 11,700 will give us 2,600 units. That would be what is remaining at the end of the month. That's the closing number of units. What we just need to find is that for these 2,600 units, what will be their cost? Remember, we are talking about closing, not opening, closing. So 1,000, remember that the last purchase we made was at 1,500, was 1,500 units. So 1,500 units of that 2,600 units, right, will be at this cost, 2.87. The remaining, after you exclude the 1,500 units, the remaining will be 1,100 units, right? The remaining will need to be from the previous purchase on the 18th. There was a previous purchase, remember, from that 4,000, 1,100 units of those should be at this cost, because remember, it's closing. So I hope that this makes sense, right? But in any case, what have we found here? As you can see, we find the total value for the sales is 60,051. It is the same. Like I said, sales won't change. Sales will always be the same. Even in the perpetual, let's go to the perpetual. Sales is always the same. Remember, the second question they ask us is, what will be the sales revenue? Right? The sales revenue, if you look at these 6,000, they were sold at 5.41. And the 5,100 was sold at 5.41. Right? Same price, right? What is the total? 6,051. Same thing for all the methods. Look at all the methods. The sales revenue is always the same. It's always the same. Look at the sales revenue, always the same. Makes sense, right? So the sales revenue won't change. It makes sense. If you look at the weighted average cost method, we are in the periodic, not the perpetual, the periodic. Do you spot the difference between the two? You can see for the FIFO, we know the value at all time, right? For the weighted average, we need to have an average. What will be the average? The average is simple. The average will be, we're just going to take the total. Remember, we calculate the total at the end because it's periodic. You don't need to calculate the average during the transactions. You don't get an average after each purchase, like we said. Remember, you get an average after each purchase for the perpetual weighted average. But for the periodic weighted average cost method, you don't do that. You do at the end. So at the end, you look at the total value of purchases, which is the 36,000, right? You divide it by the total number of units that was purchased. That's how you get the 2.64. The 2.64 is your weighted average. How many units were closing? We have already spoken about the number of units in the closing. How many? Remember, we take the 13,700 minus what was sold, remains the 2,600. So this 2,600, which is the closing number of units, we're going to multiply it by the 2.64 for the period average. Not a transaction average, a period average. That's the difference. For the periodic, you take the period average multiplied by the closing number of units, gives you the closing value. The sales revenue is the same, like we said. Okay? I trust this is quite clear. So we are close to the end. There's two other questions that we had to deal with. Is the cost of sales. What will be the cost of sales? Would be, yeah. Because you will be looking at all the sales that happened. Remember, there was 6,000 units, and there was also a 5,100 units. So every time there was sale, every time every sale, all the sales that took place, these will be the two places where you are going to account for the cost of sales. So all these that you are seeing are here. So I trust you can see it quite clearly. So in order for us to find the cost of sales, like I said, you need to look at when the sales happened. And the first sale was for 6,000 units. And we know how we split those sales, right? We split it into 5,200 units and 800 units that had to come from the 2,000 unit that was done on the second, right? And everything, because we structured it properly, you basically just take this, you multiply 5,000 multiplied by 2.5, 8,000 multiplied by 2.75, plus 1,200 multiplied by 2.75. That's all that you have here. That's how you find the cost of sales. For the weighted average, how would it be? You would also have to look at every time there was sales. But remember, the weighted average is straightforward because we have already worked out only one cost, the 2.57 and the 2.65. And that's all that you need to do, sorry. So here, it's just this. There we go. So I trust that this is clear. That's all that you need to do. So if you work out your table properly and correctly, you can never go wrong. And obviously the gross profit will be the same. You will take the sales minus the cost of sales. So sales minus cost of sales will give you the gross profit. So this is the sales minus the cost of sales. Sales minus cost of sales gives you the gross profit. It will be the same here. Sales minus cost of sales gives you. What you will notice is that the numbers are not the same. Look at the numbers for the cost of sales for the FIFO. It's 28977. Look at the number for the cost of sales for the weighted average. It's slightly different, 28935. So please don't use one method in place of another. You ought to understand each method and don't just think, oh, but at the end of the day, it will be the same amount. It will not be the same amount. All right? So we're going to finish, therefore, with this. We have about 8 minutes remaining, and we are going to finish now with the perpetual. So now in the periodic, how do we do now the cost of sales? Remember, in the periodic, everything is done at the end of the period. Nothing to be done in the middle, right? So what is going to happen is that we know cost of sales for the FIFO in the periodic, we know what is the last units, right? For the cost of sales. So actually what was sold was this. So I'm going to highlight, just give me a second, let me highlight for you. This is what was sold, right? Remember that, keep that in mind, that's what was sold. So whatever we are doing here, we are taking from, obviously because it's FIFO, we need to follow properly to see which one came first. So from from what we sold, what came first? What came first was this. At this cost. What came second was this. At this cost. What came third was this. At this cost. And if we add up these together, if we add them up together, we will find that we will only be left with 2,900 remaining for us to get to the 11,100. And so these 2,900 will come, this last one will come from the 4,000 at this cost. So there will be 2,000, and I'm showing it to you here, 2,000 that will come from here. So 2,900. Remember, everything needs to add up together to the 11. So it's not everything that we purchased that was sold. We agree. Only 11,100 units. So we will start. Okay, for us to calculate at the end of the period, the FIFO requires us to take what came in first will be the one that we're gonna take out first. So what came in first was the 5,200 units at 2.5, then the 2,000 units at 2.75, then the 1,000 units at 2.85. And if you add them up, you'll find yourself that you only remain with 2,000 units, 2,900 units to reach the 11,100 units. So these 2,900 units, where is it going to come from and at what rate? Obviously, it's going to come from the 4,000 here, and it will have this rate. That's what you see here. I trust that that's super clear. So that's how you calculate actually the cost of sales using the FIFO method in the periodic system, right? In the periodic system. As for the weighted average, it's straightforward because you know the number of units that was sold. The cost of sales will be at the weighted average cost of the period. Remember, I told you for the weighted average cost method, you calculate only one weighted average for the entire period, not after every transaction. After every transaction, it is in the perpetual inventory system. In the periodic inventory system, you don't need to do that. You only have one weighted average cost, right? So, ladies and gentlemen, that will bring us to the end of this because we will have a total for the cost of sales, and you know what happened. Once you have the cost of sales, you have your revenue, you just take revenue minus cost of sales, gives you your gross profit. And check it out, you will see that they are different. So this cost for the FIFO will be different from this cost for the weighted average. So please don't try your luck to use another method in place of another method, right? Or one method in place of another method, all right? So we have come to an end. I trust you practice this, and if you have any questions, you know where to find me. Peace.